help you pick the right stock at the right time.
Good morning, you're watching Daybreak on Bloomberg Quint Live and I'm Alex Matthew. First, the headlines this morning. Asian stocks are off to a weak start after Wall Street ended in a sea of red. Various global factors from growth to the Brexit are worrying investors. A majority of the 52 economists surveyed by Bloomberg expect the Monetary Policy Committee of the RBI to keep interest rates unchanged. Investors will also keenly await Governor Urjit Patel's first interaction after the recent standoff with the government. A panel set up by SEBI has recommended direct listing of companies on 10 foreign exchanges to enable controlling foreign investors to exit or unlock value. And after a brief 2-day surge, oil prices resumed their decline, this on the cusp of that crucial OPEC meeting in Vienna. And finally, JLR headwinds continue to weigh on Tata Motors. S&P has cut the company's long-term debt rating to junk. This is S&P's second downgrade of Tata Motors in 5 months. Let's talk about that session on Wall Street because perhaps that's going to give us the biggest cues for markets here in India. US stocks suffered one of their biggest sell-offs in recent years on Tuesday as concerns over the durability of President Donald Trump's trade truce with China stirred fears about global economic growth. Bloomberg's Sue Keenan brings you all the action from Wall Street in this report.
U.S. stocks plunged across the board in a volatile session on Wall Street where all three major benchmarks fell more than 3%. The Nasdaq was down almost 4%. The Dow fell more than 800 points at the peak of the sell-off. The S&P 500 fell the most since October 10th. All of it a result of a pile of concerns ranging from Brexit to renewed skepticism over Trump's boast of progress on the trade front and the G20 to the inverted yield curve. All of this wiped out the prior day's assets and then some, creating a risk-off environment. Trade-sensitive shares and bank stocks led the decliners. Financial shares also got hammered after a hawkish comment by one of the Fed policy members. One veteran trader said, yes, there is a halt in tariffs, but there's still no resolution. The markets are closed on Wednesday in observance of President Herbert Walker Bush's funeral. I'm Sue Keenan, Bloomberg News.
All right, I'm joined now live by Bloomberg's Rosalind Chin, who's joining us from Hong Kong studio. Morning, Rosalind. Well, not the best cues overnight from the U.S. markets, and it's not looking particularly great for Asian markets either. What do you see down there?
What I'm seeing is a lot of red across these boards. The MSCI Asia Pacific Index trading lower by more than 1% this hour. And really, as was mentioned, it's this lingering uncertainty about really what was the outcome of these talks between Xi Jinping and Donald Trump over the weekend in Buenos Aires. Because, of course, as we know, Trump has been tweeting overnight. He's been saying that he's calling himself the tariff man, saying he's going to essentially protect the American economy, maxing out, he says, the economic power of the U.S. He suggested he could extend the 90-day truce with China. But Larry Kudlow, the White House economic advisor, then pedaling back a little bit on the auto tariffs deal, saying nothing has yet been signed. Now, China has come out this morning in Asia saying that they're basically sort of supporting these comments, saying that they're going to go ahead with pushing forward with trade talks, more trade talks with the U.S. and within the next 90 days. They said the meeting was very successful and confident to implement the results agreed upon at the talks. That these comments coming from a statement on the Ministry of Commerce website, but again, no details given about actually what was agreed upon, if anything, in these conversations. So this lingering uncertainty really isn't being lifted, as you can see by the markets. We see that the Hang Seng is trading lower by 1.6%. Shanghai Composite down by more than 1%. The CSI 300 also trading lower by more than 1%. So these comments from China not really helping to lift the mood at all. And of course, there has been these concerns, of course, with the U.S. Treasuries. The inversion of the yield curve, of course, adding to concerns possibly about what the Fed might do regarding rate hikes and, of course, what it will do in terms of any concerns about a recession coming. So these all weighing on investors' minds at the moment. And of course, adding to all of this, we've also had the Foxconn Technology Group Chairman Terry Guo, one of the biggest tech companies in the world, and of course assembler of iPhone products, saying that the US-China trade war may last for 5 to 10 years. And that's according to the Taipei-based Economic Daily News, saying that the global supply chain may be forced to restructure. So not a lot of positive comments coming out there, not a lot really, it looks like at this point, to drive the markets into positive territory. So if anyone thought that December was going to be any less rock and roll than November, it seems like they're pretty much wrong at the moment. Back to you.
Absolutely. Thanks so much for that, Rosalind. Well, adding to the risk aversion overnight is also the fact that there's worries on that hard Brexit that Theresa May was talking about. In fact, Theresa May has made a final desperate plea to MPs to back what she called the honourable compromise on her Brexit deal. And she actually faced having to open a 5-day debate in the Commons, with her authority further shredded by the series of debates. Take a look.
I just ask those colleagues who wish to reopen the withdrawal agreement to recognise that were the withdrawal agreement to be reopened, it would not simply be a question of what the United Kingdom then wanted to change. It would also be a question of enabling others to change elements of that withdrawal agreement.
All right. Well, with that, I'm joined by Agam Vakil, who's going to set you up for the day's trade, and also who's going to tell you what's happening in the futures and options space. Morning, Agam. Very clear negative cues from overseas, but perhaps the one positive that I saw was that crude oil prices are a little bit down again ahead of that OPEC meeting.
Right. Well, you know, Alex, as many were mentioning, the green that we saw earlier in the week was possibly just a blip. And that's playing out right now in the global indices. And we can see that in the effect in the SGX Nifty as well, because that is coming off by as much as 0.5%. Now, we're likely to see the Nifty lose 10,900. Of course, it didn't move above that mark, but we're likely to see that happen further away. And the Nifty, as you can see yesterday, well, marginal moves there and nothing to speak for when it comes to the mid-cap or the small-cap indices. Remember, it was a very, very quiet day of trade where turnovers were absolutely average, and the Nifty Banking Index, for that matter, didn't really show too much movement. PSU Banking Index under pressure. However, do remember the banking sector may be in focus today, considering we do have the RBI monetary policy. But let's move on, take a look at other sectors, and we did see strength in the Nifty IT index, essentially on the back of that strengthening dollar against the rupee, and the US Nifty Pharma, of course, flattish moves again, despite the fact that the Sun Pharma did decline further. Now, we have seen weakness in a lot of these ADRs. Tata Motors, Vedanta, ICICI Bank, HDFC Bank, all coming off. It's same for Infosys, same for something like Dr. Reddy's or Wipro, which advanced by around 0.5%. But FIIs didn't really do too much, about 56 crores out on a net basis. It's a very small figure. And DIs also sold a stock worth around 521 crores on a net basis. But when it comes to contributors, we did see pressure from HDFC and HDFC Bank along with M&M. On the other hand, well, we did see a rise in TCS and Infosys moving on, supporting the markets to a certain extent. Let's come down to the futures and options space and see how that's panned out. Again, we've seen very little moves when it comes to the changes in open interest for the Nifty at around 1.2% increase. Bank Nifty continues to see unwinding for the third straight day. This indicates there is some amount of uncertainty, considering a lot of traders very early in the series are unwinding the positions at this point in time. So, well, we're going to keep an eye on this one as well. And let's move on and talk about your open interest distribution. Currently stands 10,500 put and the 11,000 call. So not much has changed there. But moving on in terms of the most active options, it was 10,700, 900, and 800, where we saw the most amount of activity. Then in terms of the VIX, of course, it did come off, but it's not below the mark of 18. A lot of analysts are of the opinion that they would not be comfortable unless and until the VIX comes back to the levels of around 16.5. And well, there you have it. But let's talk about the put call ratio, which is edged up higher once again at around 1.7, and the Nifty banking put call ratio at around 0.92. So it's fallen further from the neutral level of 1. In stocks, watching out for India Bulls Housing Finance, we saw unwinding there, 14% decline in open interest. Torrent Power was the other one where we saw longs unwinding, considering a 13% decline there in open interest, and Bosch saw fresh shorts where the stock declined by around 3.6%. And of course, we also have SRF where we saw, well, fresh longs. So we have a candidate with short covering, a candidate with long unwinding, fresh shorts and fresh longs in my list. So it was a very mixed day of trade, Alex. And once again, it isn't only going to be about global cues, perhaps the RBI monetary policy as well.
Speaking about that, thanks so much for that, Agam. You know, speaking about what Agam was just talking about, the RBI monetary policy, the Monetary Policy Committee is not really expected to do much today. The 6-member panel will, in all probability, keep rates unchanged, according to the overwhelming majority of the economists that have been polled by Bloomberg. But what are the factors that are contributing to that expectation? Ira Duggal has the answer in this report.
Many analysts have pointed out there's a sea change in the environment against which the October MPC review was conducted and the December MPC review will be conducted. So cut the MPC a bit of slack on some changes in analysis because the environment is entirely different. Let's look at some of the swing factors. Most importantly, it's going to be crude oil. If between the August policy and the October policy, crude oil was up 15%, since then it has tumbled down 20%. Who could have predicted that, right? So the concerns on higher crude oil prices feeding into inflation, those will be to a touch on the back burner right now. Same story, similar issue on the rupee. The rupee, which had depreciated to record lows between the August policy and the October policy, has now appreciated and is trading at about 70, which people believe is a comfort level. But again, the concerns about imported inflation, some concerns about interest rates being used as a lever to tackle the current account deficit, all of those sort of chatters, again, at the backdrop this time around and not as important for the MPC to be looking at. Of course, their mandate is inflation, so a lot of attention will once again be focused on inflation. But here again, there is a change in the environment because you have continued to see inflation underperform expectations. Food prices have remained one big conundrum as to why food prices have been so soft, but what that has done is kept the headline inflation in check. Now, granted that the core inflation numbers remain elevated, but remember, in the inflation targeting regime, you are targeting the headline inflation. So to what extent can you sort of justify acting on behalf of core inflation? That's something that remains to be seen, how the MPC actually justifies it, should it feel the need to continue acting on the inflation front. But at headline 3%, I don't think anybody believes that another rate hike is required. Also, you've got another round of GDP data, and that too has told you that growth from an 8.2% print has come down to 7.1%. So keep all of those factors in mind, and you know that there is very little reason to believe that there will be another rate hike, not just this time around, but at least going by the factors that we have at our disposal right now, any time in the next few months. So no surprises that most analysts on the Bloomberg poll are suggesting a hold call. There is some talk that perhaps the MPC needs to move back to a neutral stance, but nobody believes that it will happen this time around. Should the factors that we highlighted remain very dovish, then maybe in February or so there will be that debate about moving back to a neutral stance. But it could be a fairly uneventful policy this time around from the perspective of monetary policy. Liquidity is the other thing that has been talked about in the run-up to the policy. But again, if you look at the absolute end of this chart, in the last few days, liquidity conditions have also eased. The RBI has said it will continue open market operations, 40,000 crore to be infused via open market operations in December. They've been putting out calendars, so they've been communicating to the market as well. And the fact that they put out a calendar for December now makes it less likely that a cash reserve ratio cut is on the table. There was some chatter that that may be something that could be discussed, but it looks relatively unlikely. That's on the monetary policy front, so expect a fairly uneventful policy in some ways, although of course there's a whole host of other issues that we will be hoping to hear from the RBI management on.
Now, here's another update on a completely different topic. An expert committee set up by SEBI has recommended allowing Indian companies to list directly overseas. The 7-member panel, headed by the CEO of Avendus Capital, Ranu Vora, has identified 10 foreign exchanges to begin with. Here's Sajid Mangat with all the details and all the implications of that move were it to be announced.
A SEBI panel comprising of Ranu Vora of Avendus, Cyril Shroff of Cyril Amarchand and Mangaldas and others have recommended direct listing of Indian companies on overseas exchanges. The committee, which met since June this year, has recommended that Indian companies incorporated in India can list directly on an overseas stock exchange without listing in India. Currently, the regulations are very strict with respect to listing in overseas jurisdiction, because any company seeking such a listing requires to list in India first and then go ahead and list in an overseas jurisdiction there. The panel has identified 10 countries comprising and the exchanges belonging to those countries as eligible jurisdictions to begin with. These include some of the prominent ones in the US, like NASDAQ and NYSE. In Asia, you have Hong Kong, Korea and Japan. In Europe, you have Luxembourg, you have London Stock Exchange and others to begin with, and then gradually the panel may, or SEBI as a regulator, may expand the jurisdiction if required. As per the committee recommendation, the committee has asked the Bank of India to ease some of the regulations with respect to FEMA, which does not allow an overseas resident to invest in Indian companies unless the company is listed in the Indian jurisdiction. It has asked a similar exemption from the Ministry of Corporate Affairs to allow listing of these Indian companies in an overseas jurisdiction as well. As far as the beneficial ownership is concerned, the panel has recommended that those should be followed as applicable to the respective jurisdictions. So if a company is listing in the US, then the beneficial ownership disclosures standards should be similar to what they would be following in that jurisdiction, and that should be complied and disclosed in India as well. In the issue of taxation, the committee has recommended that there should be some clarity which should come in from Department of Revenue, and that's where the government role comes in. These entire recommendations are up for public scrutiny and comments, and post that the regulator, the Reserve Bank of India, the Finance Ministry and the Ministry of Corporate Affairs will have a final say on whether to go ahead and allow direct listing in overseas jurisdiction.
All right, and listen in to what experts have to say about this potential move.
It is time where Indian companies in newer emerging areas, specifically digital, internet, technology, they have global aspirations, they have scale they want to reach, and they have to access the lowest cost of capital. So with all of those requirements and to compete effectively in a global market, we thought it would be good, rational economically for such companies to consider getting listed overseas in permissible jurisdictions. And these permissible jurisdictions have been chosen thoughtfully with a reason. They have, of course, high quality capital market infrastructures. They have good KYC and email practices which are justifiable, and also these are markets where there is a pool of investors who have an understanding of some of the sectors.
The possibilities that open up with direct listing of shares both ways really takes the intellectual basis of opening up the capital markets to another level. As Ranu mentioned, it has in the past been essentially around depository receipts, whether they be ADRs, GDR outside or IDRs over here. And this crosses into the next threshold of direct listing of shares, and consequently opens up a much wider avenue of potential investors, and is also a hallmark of quality for the standard of regulation in the market. So once it finally goes ahead with all the bells and whistles being tied up, it would be huge in terms of the natural evolution of a big capital markets like ours.
Now, one of the headlines in the recent past has been the movement of crude oil prices, and perhaps that recent uncertainty will somewhat be clarified tomorrow when the OPEC meeting takes place. Saudi Energy Minister Khalid Al-Falih has dismissed suggestions that OPEC and its partner producers such as Russia will cut output at the next meeting as premature. Speaking to Bloomberg's Anne-Marie Horden, he said that while projections said that there would be an oversupply of 1 million barrels, the market would have to wait until the Vienna meeting to be certain about that figure.
What we said in Abu Dhabi is that projections are that there will be 1 million barrels of oversupply, and that we will wait until we get to Vienna and ascertain what that number is. And the next, I think, road to cross is whether all countries are willing to come on board and contribute to that cut.
All right, we'll know soon enough. For now, let's turn to other news. BK Birla Group firm Kesoram Industries will spin off its tyre business into a separate entity this new year. Birla Tyres will be then listed on the exchanges. Sharad Dubey has all the details.
Kesoram Industry makes its second biggest move to pare its debt by demerging its tyre business. So basically the company will demerge its business into Birla Tyres, which will remain listed, and the company also states that January 1 will be the appointment date for the business spin-off. Birla Tyres will issue 1:1 equity shares to Kesoram Industries at a nominal value of around 10 rupees per share. The turnover of the demerged business stands at around 1453 odd crore rupees, and the percentage of turnover segment-wise, the tyre business contains around 39%. This is as per the annual general report of financial year 2017-18. The rationale for this move is to revitalize the product portfolio and to leverage positive brand equity of Birla name for the new demerged business. 2 years ago, company had sold its tyre plant for around 2,000 odd crore rupees and to reduce its debt, which had stood at a staggering 5,300 odd crore rupees. But will this move change the credit profile of the company? Only time will tell.
All right. Well, Yash Upadhyay is joining me now with the stocks in news. Yash, what are the stocks on your list today? Good morning.
Morning, Alex. There's been more bad news coming in for Tata Motors as global ratings from S&P Global has downgraded the long-term credit rating for the company and its luxury car arm Jaguar Land Rover to BB-. Now, this is the second ratings downgrade by the global ratings firm in the last 5 months, citing headwinds for the company's Jaguar Land Rover subsidiary. Interglobe Aviation announced the appointment of Ranjay Datta as the principal consultant to develop a 5-year plan for the airline company as it seeks to expand its presence in the global space. Hinduja Global Solutions would be in focus as well as it doubles down on its expansion plan in Scotland, as the company has announced that it would be creating up to 150 brand new permanent jobs in the country and would be investing over the course of 2019 at its site in Selkirk. That apart, we'll be watching out for Kridan Infra as well, as the subsidiary of the company has received an order worth close to 105 crore rupees for a highway project in Maharashtra.
Thanks so much for that, Yash. Now, over to the big brokerage calls of the day. Somit Sarkar is joining me now with a couple of them to tell you about. Morning, Somit. What do you have for us today?
Good morning, Alex. And the big brokerage calls for the day, first we have is ICICI Direct on Phoenix Mills. Now, the brokerage has initiated coverage on the stock with a buy rating and a target price of 775. Now, Phoenix Mill, who is a market leader and owner of the prime malls in India, is a unique proxy play on Indian retail industry, says the brokerage. Now, according to the brokerage, the company's retail portfolio is expected to double, which would lead to a 14% annualized growth in its rental income over the next 5 years, says the brokerage. For such kind of growth, the company is well funded on the back of its alliance with Canada Pension Plan Investment Board and on the back of its strong internal accruals, according to the brokerage. Lastly, the brokerage says that the current valuations of the company does not value in its expanded portfolio, and that is the reason why it has initiated a buy rating with a target price of 775. Second, we have a CLSA on Cadila Healthcare. Now, the brokerage has upgraded the rating on the stock to buy from outperform and has also hiked the target price to 430 from 410. Now, according to the brokerage, complex product approval cycle remains strong for the company, which would enable Cadila to witness a high single-digit growth for its base business. Now, Cadila has been developing vaccines and biologics for India and other emerging markets over the last few years, and going forward, monetization of these would generate an incremental revenue of close to $500 million for the company in the next 5 years, says the brokerage. For the long-term view, the acquisition of Heinz is likely to augment the current portfolio of Zydus Wellness and strengthen its consumer business, says the brokerage. Lastly, the brokerage has upgraded the rating on the stock to buy on the back of cheaper valuations, which have turned the risk-reward favorable for Cadila Healthcare.
All right, thanks so much for that, Somit. Well, there's clearly lots to talk about over the course of the day, and you'll find all the live market action right here on Bloomberg Quint Live. There are also a few stories that you should consider reading on the website bloombergquint.com. Here are just a few of them. Bloomberg Quint has gotten access to the resignation letter R. Chandrasekharan sent to Yes Bank. In it, he said, and I quote, "I have been deeply concerned about recent developments at Yes Bank and dismayed at the manner in which they have been dealt with. It is even more distressing that all this should have occurred during a critical transition period when tact, wisdom and purposeful, well-considered actions were called for," unquote. Do look up the story on the website for everything that has to do with what he said. Now, moving on, the government-appointed board at IL&FS has plans to slash 2/3 of the jobs across the group as it aims to revive the systemically important conglomerate. Axis Capital Chief Executive Officer and Managing Director Dharmesh Mehta has quit to pursue other interests. The board has elevated Salil Pitale and Chirag Negandhi as joint MDs and co-CEOs with immediate effect, subject, of course, to approval from the regulator. Now, where did everyone go in 2018? Which hotspots at home and beyond got people's pulses racing? Take a look, and this list might just surprise you. Well, thanks so much for watching. Just a small point before we leave Venkata. As you can see, the sun isn't up yet, but we still wanted to show you a bit of it, whatever we could get. Thanks so much for watching. This is Bloomberg Quint.